Yeah, I don't even know. I don't even know who's still in. I have paid zero attention to it. I do know that Ohio State women lost to Notre Dame yesterday.
Yeah, I saw that actually. Probably the second half of that one. It was a good game.
Yeah. Then I saw North Carolina, or not North Carolina, UConn just crushed Syracuse in the women's, but that is all I have seen.
Yeah, there's some teams that are just, especially on the women's side, there's some teams where there's just tremendous disparity. They just get, and certainly the NIL slash money free for all doesn't help that disparity at all, does it?
Yeah, yeah. I checked because I do play the CBS pools. So I played three men's brackets and
Nice.
I looked over the weekend and I was like 15,000 something, something, something in the
But
ranking.
if it's out of 100,000, that's pretty good, right?
Yeah, I don't know how many people it's out of, but I was just like, yeah, it's crazy. All right, everyone, we're just waiting for people to get loaded and we will get started shortly. You are at the right place. You didn't just join ESPN's commentary on NCAA basketball.
Yes, we're gonna have some AI note takers in there.
Yeah, I jumped on a meeting yesterday and I was right on time, which is unusual. And it showed there were three people in the meeting. So I like while I'm turning my camera on, I'm like, "Hey everyone, how you doing?" And then I
Was all
realized
AI.
it was me and three note takers.
Note
There were
takers.
no humans in the meeting. Like,
Welcome to the
oops.
new day.
Yeah. All right. For the sake of time, we are going to go ahead and get started because we have quite a bit to cover today. So, welcome back, everyone, to the SIP, where conversation sparks connection, collaboration inspires innovation, and industry leaders tackle today's biggest challenges. Think of it as catching up over a coffee or an adult beverage while watching an NCAA basketball game, only with insights that move our industry forward. At TMC, we're passionate about empowering our members to thrive, and today's show features a real world strategies and perspectives that only come from working together. And I have a really meaty conversation in store, and I want to warn you in advance that it's one where you want to take notes, or I guess let your note taker take notes, but make sure that you eventually get back to it. So, today's episode is proudly sponsored by Vice Capital Markets, and I'm thrilled to welcome a true industry veteran to the SIP. Chris Bennett is the chairman of Vice Capital Markets, and if you have been around the industry long enough, there's a good chance that you have crossed paths with him. He has been at TMC or Vice Capital Partners has been TMC Partners for over a decade, actually, since back when there were only six lenders in our network. So, Chris, you were with us before most people even knew what TMC was. So, welcome to the SIP.
Hey, thank you so much, Jody. Actually, I wanted to be on the show last year. I didn't realize how popular it was. So by the time I got in there to try and say, "Hey, what dates are available?" I was told we're booking 5 months out. I'm like, "Oh my goodness!" So I'm glad to finally be able to be on the show with you for the first time.
Yeah, we're very excited. Definitely, our audience has made the show come alive, and it's been growing since its inception last spring. And we have amazing sponsors and people attend like yourself that make it so valuable. So, thank you. Before we dive in, can you give us a quick update on what came out of the Fed meeting last week? It seems like we've had a lot of news out
Yeah,
of.
I'll keep this one to 60 seconds, I promise.
All right.
While the outcome of the meeting was never in doubt, what was interesting is their SEP, the Summary of Economic Projections they do every 3 months, where they project what they'll think about inflation and the future of the Fed funds rate. And what was interesting is that three of the Fed voters who had projected no cuts at all for 2026 changed to projecting a 25 basis point cut in 2026. So, if any, and actually, as Chairman Powell said in the meeting, if there was ever a time where you're going to say things like data dependent and we're really uncertain and we're not sure, the chair tried to do a good job, I thought, of saying not just we don't know what'll happen, but also that we're not going to freak out because oil just went from $65 to $105. It was kind of like, how do we use the term transitory without actually saying the bad word of transitory? We're fortunate that, so for example, Bank of England, since the war started, the investor expectations for Bank of England have gone from 50 basis points of cuts to 75 basis points of hikes. It's huge. The other central banks only have one main goal, and that's fighting inflation. We're lucky that the Fed has dual goals of inflation fighting and full employment. So we haven't had that dramatic change in investor sentiment. It's gone from expecting a quarter point ease to about average. I guess the one thing I'll say on it is, for folks who kind of are expecting that, well, Trump's guy, Kevin Warsh, is coming in May, he's going to bring rates down, we're going to be in great shape. I got bad news. That's just not how that's going to work. It'll be a different Fed, certainly with at some point, Governor Warsh running the show. But the vote, for example, last week was 11-1. The new person isn't going to come in suddenly throw the rule book out and say we're going to do this instead. So we'll have to be a little patient and see what happens.
Not my greatest quality, patience, but love it. Thank you for that update. Now let's talk about some things that are actually in our control as lenders, because that's really what this is all about. On another recent news item worth touching on, the two executive orders that dropped on Friday the 13th, I'm happy to say they didn't take on characteristics of Friday the 13th, and I think are actually good news because it shows that there is a focus on lending. I know the markets have a tendency to react just about anything coming from this administration, even tweets, but this was a meaningful step forward for housing. If properly executed, which we know is that's to be seen, if properly executed, it could be a significant win for lending. Were there any notable market reactions to those executive orders that you noticed?
No, I agree with your assessment, Jody. Interestingly, there really was a very muted market reaction to it. Certainly, all of us in mortgage lending view it as a positive. There's nothing negative in it. But really, when you look at things like home builder stocks, look at stock prices movement of community banks, when that was announced, there was really almost no reaction to it. So I think it could be a case of, and I think it's not from getting, I guess, sort of having so many things come out that we don't react to them anymore, but it's almost kind of like, of executive orders that happen, some are more kind of like proclamations of, hey, I'm directing this to be the future. It's not something that's super concrete where here's an executive order and tomorrow here's new rules that apply. This is going to take some time. Actually, a good amount of these executive orders, this particular one anyway, requires updates by the CFPB. Well, of course, as we all know, actually, can I use this term? The CFPB has gotten gelded. I don't own horses, but is that the right term, gelded?
That is effective, yes.
All right. So the CFPB is, a very, very core shell of its former self. I mean, of course, this is a solvable problem, right? It's not permanent. So maybe they can use Claude or some other AI to kind of help them make the new updates. I'm not sure. But it's not bad news. It's good news. We don't have any immediate market reaction to it. We just don't know how long this is going to be and how it's all going to play out. One of the prior executive orders, this is from 2 months ago, to kind of put that in a little bit of context, was about, if you recall, it came out as a tweet, or actually it might have been Truth Social post, saying, I'm going to direct my representatives to have Fannie and Freddie buy $200 billion of mortgage-backed securities.
Yep.
And that's started to happen. And part of it is, as the Fed has been shrinking its balance sheet of mortgage-backed securities, part of this is trying to sort of push that demand back out that had been diminished from the Fed not participating anymore. So Fannie and Freddie have both started to kind of put their toes in the water a little bit. What's happened to those swaps? Well, let me talk about, those spreads rather between mortgage-backed securities and treasuries. Kind of back up for just a second here. If we take a look at a comparable 5-year or 10-year treasury and say that's a 4.25% yield right now, and we look at a Fannie and Freddie 5.5 coupon mortgage-backed security and say that that's at par, that is a spread from mortgage-backed securities to treasuries of 1.25% or 125 basis points. Now, those spreads right before that announcement 2 months ago, they were around 110 basis points. They'd gotten better from where they were a year or two ago. As soon as that announcement came out, they dropped to 95 basis points, meaning all other things being equal, mortgage rates going down by another 15 basis points. Then, as we got just to the eve of war, they went back up to 110, and they got to the point yesterday or 2 days ago where they were at 140. They had really blown up. So Fannie and Freddie both came in and started buying a good amount of mortgage-backed securities, A, to take advantage of historically high spreads, but B, in an effort to try and push those spreads down, which were really ratcheting up so much. So that's an example of an executive order that at the time we weren't sure, well, how's this going to be implemented? What's the timing going to be? But it's actually already happening, and it happened in earnest in the last day or two.
Yeah. Well, we definitely, if anybody asks, the Mortgage Collaborative and our advocacy committee would be happy to put together a framework and ask AI to generate how that could be implemented at the agency level. We'll be right there to support the CFPB if they ask. So,
Absolutely.
So Chris, I wanted to start here because I think it's there is misunderstanding at the leadership level about Fannie and Freddie and the actual prices. And when the C-suite leaders do not fully understand are the mechanics, and it becomes very hard to make good strategic decisions. So let's clear some things up. I called those your myth busters in my LinkedIn post. But what are the biggest myths you hear from lender executives about how the GSEs work, and where did those misconceptions actually cost them money?
Yeah. It's multifaceted, right? There are a number of perceptions. One is that Fannie and Freddie give the big guys and gals lots better deals than the small guys and gals. And many years ago, that was indeed the case. It isn't so much the case at all anymore. In fact, we see cases where it's not unusual to have a very small seller, say someone who's doing 5 million a month in mortgages, actually have better pricing than a lender 20 or 50 times their size. Not that it's common, but it's not uncommon. When Fannie and Freddie came out several years ago and say, we're leveling the playing field for folks of all sizes. There is a good amount of truth to that. Certainly, large lenders have a lot more interesting things that they can do with flexibility because of their size. But if you take a look at a lot of mortgage collaborative lenders go through the cash window. So as opposed to saying, I'm going to form my securities, here's my guarantee fee, I can see exactly what my pricing is, you're getting pricing that's just published out to you every day and really every minute of every day. So there can be a perception that Fannie and Freddie each have people hidden behind kind of that curtain in the Wizard of Oz that are constantly turning these dials up and down. Or even I hear people say, Fannie was super aggressive today, or boy, Freddie really wanted to just buy the whole market today. And that just isn't how that works. For every lender, Fannie and Freddie each have a case where they have an implied guarantee fee for them. That's what they're charging essentially to guarantee these mortgages. And that's largely based on how your portfolio performs. What's your delinquency rate look like? What's your average credit score? How is it actually performing? The other part that goes into that are the actual raw price of a mortgage-backed security, which of course ticks up and down every minute. And the other part is really has to do with your prepayment speeds. How long do your loans last? Part of the value of the money that's being put into this model and what Fannie Mae and Freddie Mac are paying you for has to do with how long this loan on average is expected to stay on the books. If you're a seller that has very high prepayment speeds, you're churning your portfolio, your loans are only lasting 2 years and 3 years, you're going to have a lower internal buy-up ratio with Fannie and Freddie than kind of a sleepier lender whose portfolio on average lasts 5 years, 6 years, 7 years. It's worth more to Fannie Mae and Freddie Mac because they'll have that income stream for longer. So we can take all those out, and we've got programs that we can pull your cash pricing and crack out exactly what those figures are for you. But it isn't just based on the big guys and gals get this pricing and the little guys and gals get this pricing. It really isn't based on that at all. It's based on those things in terms of your performance, your portfolio, and it also is based to a pretty significant degree on their perception of the competitive landscape for you. If you're kind of a one-trick pony, you've got one agency and you don't really do anything else except sell your loans to that agency, there's a very high likelihood your price is meaningfully worse than it is to a lender who's in a competitive situation. So that's very that's very important to consider and make sure that you're aware of. Don't just say we're an X agency shop. You need to be able to make sure that you've got choices to ensure that you've got a competitive situation there.
Yeah, and I think that, I mean, it's a great point. So for those who have Fannie and not Freddie, or have Freddie and not Fannie, going out and getting that, it's not a huge hurdle anymore, to be able to get your conventional agency tickets. Now, if you want to go for your Jenny, it's a little more tricky and a lot more
Indeed.
requirements, and takes a lot more passion and perseverance than you're anticipating. But if you could, if I were a CEO or a CFO listening right now, or really anyone in cap markets or is helping in the sale of loans, what are the takeaways from your comments that you just provided?
Yeah, and I think it applies in a lot of cases. One of the most important things that it still matters, and it matters, maybe even more so than before, are the relationships that you have. If you've got agency relationships, have those relationships, have it with an actual person who's looking out for you, that wants to help your business succeed because they're trying to manage their own P&L. Things
Yeah.
have changed now, compared to, say, 1, 2, and 3 years ago, with what FHFA allows. Fannie and Freddie now, as opposed to, like I said, a year or two ago, where they were kind of just doing whatever FHFA told them to do and building their balance sheet, they're now more willing to truly directly compete with each other. The landscape has changed as that pendulum kind of swings back and forth as we have different administrations. So you can go to Fannie Mae and Freddie Mac, who have been artificially kind of constrained with this mission from 2 and 3 years ago of, we only want you to support single family owner occupied housing. I'm sorry, I shouldn't say about single family, but we only want you to support owner occupied housing, because obviously they need to support multifamily too. But now they've got the ability, and FHFA is allowing it to happen, to take areas where the pricing has gotten, they were kind of forced to have pretty rotten risk-based pricing, non-owner occupied, second homes. And they've got flexibility now. We're not talking about just being able to tune something up by 20 or 30 basis points, but it can be a point or more to better compete with those kinds of loans that they weren't able to do in the past. So having a good relationship with your agency reps is very important. If you've got an agency relationship and you're hedging, you should absolutely have a relationship with that agency's trade desk, Fannie Mae's trading desk, Freddie Mac's trading desk. In addition, to have a good relationship with all your investors, those account execs, if you're selling whole loans on a whole loan basis to investors. Well, I talked about Fannie and Freddie not really having anybody turning those dials back behind the curtain, other than being able to go to them and work on some specialized deals. A lot of investors have account execs that are managing their own P&L. They're given core models, and if you can work with them to help them to earn more of your business, it's only going to benefit your company as it is. One of the things that we see sometimes people do, and it's hurting them, is, let's say you have a company that used to always go to market once a week. Every week they take the newly closed inventory, they put it out to bid, however they do it, and they execute. And suddenly they decide, well, we want to go to market every day now. So when you change from going to market once a week to going to market every day, you've actually made yourself an 80% smaller lender. If you were selling $20 million of loans once a week, and now you sell $4 million of loans once a day, you might actually have more investors than you do loans to sell that day. So there's something that I understand, especially IMBs want to be able to turn their line a little faster.
Yeah.
But don't make yourself a smaller lender. Make yourself a bigger lender. And again, work not just with agencies, but work with those investors that you sell loans to make sure they know that, hey, your day is Wednesday. I'm going to take a look at this. I'm going to get our pencil really, really sharp for you. In the end, whatever somebody has won a loan by is something they've paid more than they had to. And it's important in terms of maximizing your execution to make sure that you're maximizing the interest in what you have for sale.
Yeah, like great point. So I come from the operational world. So my response to, you want to turn your warehouse line fast, turn your warehouse line fast by having high quality loans. So when then they get there, they sell quickly. You can deliver quickly once they're allocated, and then they sell quickly, so that it does allow you to only trade once a week. And then also, from the agency perspective, if you don't have a relationship, even though Fannie and Freddie are not preferred partners of the Mortgage Collaborative, we still have relationships with Fannie and Freddie, very deep relationships in many instances where we can help you move that relationship, get in touch with the right people. And Fannie and Freddie also offer education and offer help with their tickets. So those are all things that the Mortgage Collaborative can help our lender members with. You just need to reach out to your member engagement person and we can get you in touch with the right people at both of the agencies. So, Chris, the last few years, I think I'm cautiously optimistic that we're on the upside of it, but they've been brutal for a lot of lenders. Rate spikes, volumes collapsed, margins compressed, and we watched a lot of companies make some very painful cuts, but not every struggle has been equal. You have a front row seat to this because you're working with lenders of all sizes and types. What were the real differences between the companies that hit their earnings goals in those lean years and the ones that could barely break even?
I think one of one of the, and it really, I think this applies not just to bad times, it applies to normal times as well. But one of the key differences we saw was this. The companies that did well, that successfully actually hit their margins even during difficult times, did things like they kept servicing. Those are the cash streams that they needed during these very difficult times to not only just make it, but actually allow them to grow, to take advantage of a down market, to expand their footprint and grow their market share. They didn't do things where, they started running out of cash, so they took the service and they created and they hurry up, let me sell this, I have to have cash right now. And then lo and behold, what happened 8 months later? All that cash was gone. So it really was about taking a longer term view to it and looking beyond just chasing the extra 1 basis point here. And I'm not poo-pooing 1 basis point. Lots of companies can look and say, hey, if we can make an extra 1 basis point and everything, that's $200,000 a year. I'm not saying that isn't significant, but sometimes folks got too concerned about how do I make an extra nickel on the Jones loan and not from a strategic standpoint, how do we want to go to market? How is the way our company is going to survive these times that we're in and make it so we can actually grow when the market's shrinking and now really outperform once we get back to kind of a more normal time. They didn't cannibalize themselves. They looked at different ways of going to market. If you're a depository, if you're a bank looking at the FHLB, for example, if you're an IMB looking at your warehouse costs, it surprises me how often IMBs don't look at their warehouse lending costs. I've even had cases I've asked people, what's your cost of funds with your warehouse lenders? And they say, I'm not really sure. I was like, well, you're the CFO. You really should know. I think it's just note rate. It's just easier that way. No, sure, it's easier that way, but there's a whole lot of money left on the table. You make everyone else that you do business with, that you partner with, compete for your business. Why on earth wouldn't you make your warehouse lenders compete for your business too? There's real money to be had there. A mortgage isn't some sort of radioactive hot potato that you're just trying to get rid of as soon as possible, right? You're a mortgage banker. You can actually make a positive spread, especially in this kind of environment.
Yeah, and that's really interesting because I think a lot of lenders assumed that it was just about cost cutting and, shaving off, technologies that weren't being used, having to do some riffs and really just a cost cutting focus as opposed to more what you're talking about, what is market execution. We do have a comment in the chat, so kudos to coming from Mark, who is on our lender member board. They said they did really well because of working with Vice Capital Markets as their hedging firm. So thank you for that, Mark.
Appreciate it, Mark.
And thank you, Chris. But I do think you're describing more of market execution as opposed to cost cutting.
Yeah, for sure. And I think a lot of times it can be more about the primary market, right? If you take a look at a $200,000 loan, right? MBA says the average cost to originate a loan is $10,000. So you have this $200,000 loan and you say, well, we pull this pricing in, it comes in our pricing engine, our margin's 250 basis points, and boom, that's how we price it. Well, you just priced a loan to make $5,000 and your average cost to originate is $10,000. How many of those do you want to do? So I think a lot of times what lenders need, and this was another big difference between lenders we saw hit their earnings goals and lenders we saw struggle to break even, is being thoughtful about pricing. Thinking not just in terms of basis points and everything, but looking at dollars per loan. We saw, yeah, a lot of cases where companies, just they say, well, I'm gonna pull in all the pricing from all my competitors into my pricing engine and show it all to my loan officers, and they're going to pick the very best lender's price, and that's going to be their price. So they found that, they're passing along all these low loan balance payups and wonderful things, and they're killing it on the $150,000 loans that, in our example, you're losing $6,000 a loan on. And when it comes to ones that are 500,000 and 700,000, their margin structure is such that they get creamed on it because they're trying to make the same in basis points between this loan and that loan. So it's really about being thoughtful about how you price. And again, there's nothing wrong with being a broker, but if you're going to go through all the risk and the trouble and everything that's involved with being a mortgage banker, why give up one of the most important things you can gain out of being a mortgage banker, which is getting to be in charge of your own margins? There's actually, I'm going to give a little plug for this. This is a book that I read 5 months ago called Protect the House. It's by Todd Ledden. I don't know Todd Ledden, but people had asked me before, is there a book on this, Chris? And for 10 years, Demystifying Mandatory by Jennifer Fortier, which is a great book, was the only book that exists out there. It's been out of print. I think it's $100 on, if you can buy a used copy of it. But this one, I actually, like I said, I don't know Todd. I found his email address and sent him an email telling him what a great job he did. It's terrific. Actually, if anybody wants a copy of this, email me after the show and I'll have it sent to your office. I promise. It's called Protect the House. And a lot of what it talks about isn't just the ins and outs of capital markets, but it's in how you need to price in a thoughtful manner to actually maximize your profitability.
Right. So Chris, amazing insights and very helpful, but I want to make sure that we spend a few minutes on the business. So Vice Capital Markets, because I think people in our industry know the name, but they don't fully understand the breadth of what you do for lenders. And I know you're not here to pitch, but if you could please spend a few minutes on what you actually do and how you help mortgage lenders, it would be extremely helpful.
Okay. No, I appreciate that. We've been in business for 25 years. I founded the company 25 years ago. I know I don't look that old, but it really has been that long. Our average trader actually here has about 15 years of experience. We help lenders of all sizes from 5 million a month to billions a month, with everything, not just from hedging, but in pricing. Like I was just talking about how important it is to have thoughtful pricing. With all the position reporting, the pull-through reporting is really everything that we do from a pull-through standpoint is all custom designed. All that modeling is really, really important to my way of seeing things. Our reports are very easy to read. We actually use AI extensively here at Vice Capital. Probably allows us to, in a development standpoint, do 5 times what we used to be able to. And now working on things where it's very important to be able to read your reports, but also taking and giving a nice written AI generated but oral summary so that somebody who isn't going to be in the weeds, a CFO, CEO, bank president, can in 25 seconds read words about here's what the market did, here's what happened to your position, here's what's coming up today. Be able to quick delete and go back to running their business. And one of the most important things we have here is that just over 1/3 of our clients are TMC lender members. So we've been very, very fortunate to we have such a deep relationship with TMC. We've been very, very grateful. We have 5 different trading platforms, electronic trading platforms that we trade on, plus ViceX, which is our own proprietary trading software, which we can license out now to folks that want to do their own trading. Investor cash. We hedge servicing for people. A lot of people don't know that. Hedging servicing actually is called a carry positive. If rates don't change, you actually get paid cash to hedge your servicing. So I guess one final thing, I'd love to talk to anybody, whether they're a client of ours or not. We'd certainly rather you were, but always happy to help anybody in the collaborative. But sometimes there's a misconception that Vice is great if you want them to do it for you. While we've traded a lot, we actually just crossed the $1 trillion mark in trading a couple of years ago. We actually have just as many loans currently hedged on our platform that are traded in-house by lenders themselves than we do that are actually traded by our own traders. So while it's love to hear that Vice is great if you want them to do it for you, I want to say Vice is also great if you want to trade it yourself.
That is awesome. I do want to mention to everyone, Chris's Super Bowl of cap markets is right around the corner. The NBA secondary is coming up, and I hear that you and the team will be co-sponsoring Margaritaville or Margaritas over Manhattan, the
Yes.
TMC event, and our network and the entire TMC team are grateful for your support for this, but also over the years. But you can all see Chris there. So Tuesday, May the 19th at Margaritaville. And Chris, this has been an amazing conversation, and we could keep going for hours, but I have to give the audience a big thank you for sticking with us and getting these insights and so much that they can walk away with, including a book. If someone wants to get in contact with you, will you give them your email address or how you would like for them to reach out?
Yeah, absolutely. Very easy on vicecapitalmarkets.com. Actually, we have a couple case studies even you can find on there with TMC lender members on kind of how we've helped them and partner up with them. Email is cbennett@vicecapitalmarkets.com or just go to our website, click contact, and hit me right through there.
All
Very glad to
right.
help out any way that we can.
All right. Thank you. And to our audience, thank you for being here. It's exactly why this SIP exists. And we're not here to check a box to sit through our webinar. We're here to have real conversation with people who have something meaningful to say and who help push the industry forward. Huge thank you to Vice Capital Partners for sponsoring today's episode and for being a part of the community for over a decade. This kind of loyalty is a perfect example of the relationships that TMC builds in the industry, and it demonstrates the impact that we can have by all working together. So until next time, cheers. Keep sipping.
Cheers. Thanks,
Thank you,
Jody. Thanks,
Chris.
everyone.